Hi, this is Ashwin with over 13 years of experience in catastrophe modeling, insurance and reinsurance analytics. As part of financial statements tutorial, today's discussion will be on cash flow statements. So today we'll discuss what a cash flow statement is, what are its activities, what are the types of methods in a cash flow statement, and we will also look at an example of cash flow statement. So let's have the PPT started. So what is a cash flow statement? It's a summary of business cash inflows and outflows over a period of time. So there are two methods in preparing cash flow statements. So as we discussed as part of income statements, we have cash method and we have accrual method of accounting. So cash method is will be recognized when cash is received and expenses are recorded when cash is paid out. Whereas in accrual method, revenue is recognized as it is earned and expenses are recorded as they are incurred. So in cash accounting, technically we only will have one financial statement as cash method is when cash is received and cash is paid out, and hence it will be equivalent to the income statement. But the thing is, since it is only for small businesses, as we discussed as part of income statements, it is not allowed under IFRS or GAAP procedures. Coming to accrual statement, in accrual statement, we require a separate cash flow statement, profit and loss statement, and balance sheet, as revenue is recognized when earned and expenses are recorded when incurred. So we'll know in detail what each of these mean in the upcoming slide. So what are the activities that are part of cash flow statement? So the cash flow statements are divided into operational activities, investing activities, and financing activities. So the below are calculated from the above three activities: cash and cash equivalents at the beginning of the period, and cash equivalents at the end of the period. So by this we will calculate what are the cash flow statements that are available in that particular financial year or probably financial quarter. So let's look at definitions of each activity, starting with operating activities. So it's the prime revenue registering activities. So cash flow involved with selling of goods and services. And what are investing activities? So cash flows involved with outside of business core operations. So they involve with buying or selling of investments or probably the long-term assets. And what are financing activities? Funding of business or repaying cash to third party banks or probably the owners of the business from financial activities part. So here is an example of cash flow statement. As you can notice, we can see operating activities, investing activities, and financing activities. In the operating activities, we have cash receipts from customers, we have payments paid to suppliers and employees, and we have interest paid and income taxes paid. So whatever is payments, whatever are payments, they are part of expenses, and whatever are receipts, they are part of income. So that's why they are denoted as positive, and whatever are payments, they are denoted as negative. So it comes to a net cash flow from operating activities of 70. Now coming to investing activities. So any purchase of property, plant and equipment, because it is purchase, it is outflow of cash. That's why it is negative. And in any receipt is positive. Now we can notice that net cash flow from investing activities is minus 55. That is minus 70 plus 15. Now, coming to financial or financing activities, you can notice that the proceeds from long-term borrowings are 20. Hence, net cash flow from financing activities are 20. So, if you add up operating, investing, and financing activities, it comes to a net increase in cash of 35. So, cash at the beginning in Jan 2023 is 150, and cash at the end of December 2023 is 185. So that net increase in cash is 35. So as you can notice, operating activities can only be done by direct method, but whereas investing and financing activities can be done by both direct and indirect method. Let's understand what direct method is. So the direct method adds all the cash payments and receipts, including the cash that is paid to the suppliers, cash receipts from customers, and also the cash paid out in salaries. So this method is easier for probably very small businesses, and it is used as cash basis accounting method. And what is indirect method? So in indirect method, cash flow is calculated by adjusting net income by adding or subtracting differences resulting from non-cash transactions. So non-cash items show up in the changes to the company's assets and liabilities on the balance sheet from one period to the other. So this summarizes the direct and indirect method with the example that we have seen in the previous slide. So thank you for your time, and I would like to know if at all you have any feedback. Many thanks.